All right, everyone, this is Marco Palmero, founder of Ulysses in Dubai. And in this video, I'm going to share with you 8 things I do with my team at Ulysses to mitigate risk when it comes to evaluating and negotiating small business acquisitions. So I have a long list in front of me to give you as much deals as possible and share with you some of the processes that we follow to, again, mitigate the risk in each transaction. And I feel it's important to share this, especially when it comes to small business acquisitions, because one of the major things I always want to do is mitigate the risk. And it is important for us to make sure the exposure is minimized. And we might say that even if the opportunity is not super good, but the risk is very low, that is a huge plus for us. And we might consider the deal as an acquisition opportunity. So let me pick up the list quick and go over these elements and these things with you. Now, the first thing I always want to do when I mitigate risk with my team is analyzing the industry and competition of the company I want to buy. That, of course, goes without saying. I'm not going to spend too much time on it, but our external accounting and legal team can do that type of work for us. Of course, we do our own research internally too. But the point is, this is just a matter of understanding the market, the competition, the industry we are playing in, and the geographic focus of the businesses that you're planning to buy. Once you got that, you can make it through an assessment and then understand if there is risk there or the risk is pretty mitigated. And that, from my perspective, also goes back to your initial selection criteria for the industry and businesses that you want to buy. For us, we clarify that up front, and so it's less work afterwards, but still there is some analysis that goes into that to make sure the target isn't too risky from that perspective. Then I consider the business growth potential. Of course, if I see a lot of potential for growth, we might say that the risk is lower because we see the industry as growing, as consistently performing. It has been like that for 5-10 years. So we don't see problems in that particular business if we continue to do everything right. So, other industries that might be shrinking might be a little bit more risky and something that we might not want to be involved in. Now, point number 3, conduct comprehensive and thorough due diligence. Of course, it goes without saying. Our teams, third-party teams, work on that. It is mandatory to reduce risk, to identify red flags, and analyzing the deal inside out. That, of course, is one of the key components of this risk mitigation list. Due diligence is fundamental, really the foundation of any small acquisition, at least from my perspective, or perspective. Then point number 4, and that this I think is going to be an interesting one, is I keep the seller on board for the transition. This is a concept that I think is common to all big acquisitions, but not so common for small business acquisitions, which is the idea of having the seller stay for some period of time, depending on what is the value he's adding to the business and how much is involved in the daily operations. I think that is important because it enables the new management team to step in and have somebody who has the track record of building that business, helping them with the transition. I think a clear cut is not good because a lot of things can happen and go wrong. So I prefer to keep the guy on board, and the more he is involved in the business, the more I want to keep him involved. That's my thing, because again, if he's involved a lot, I can then reduce the risk by keeping him for a long time and having him train us on the processes that we need to follow, if there's anything that we need to follow at all. Number 5 is I have the seller defer part of the payment. This is a concept that I haven't covered in many videos because I don't like to talk about it because it's a little bit of a secret sauce. But the point is, not necessarily you need to pay everything up front to the seller. You might have him defer a part of the payment and have him take some risk with you. Because if he's really committed in selling this thing and he's truthful about the value of the business and the performance the business has delivered, then he's going to retain the money for some time because he knows the company is going to perform well. And if he's not willing to do that, my perspective is, Why is it that you don't want to do that? Is the business not what you say it really is? Are the numbers not real? Maybe this is a huge red flag. Maybe we need to go back and check. And so having the guy agree to that also is a huge factor for me from a due diligence standpoint. And of course, it enables me to mitigate risk because we have less exposure upfront. And part of that proceeds are paid out of the cash flow of the business if everything is done right. I'll probably share more videos about that because it's very, very interesting. Now, number 6, I consult with the best and retain the best advisors. Kind of like goes toe to toe with due diligence, but the point is some people just hire cheap firms because they want to save pennies on due diligence. But the point is these guys are going to deliver crap work. They're not going to know what they're doing, and they're going to advise you wrongly. So you're going to make mistakes. They might cost you a lot more in the end. So why are you doing this? From my perspective, having the best that work for us and with us is mandatory because it enables you to avoid painful mistakes later down the line. And so this is a huge factor for mitigating risk because the stronger the team, the better the outcome. That's my thing and something I really believe in, and I'm very passionate about that. Number 7, non-competes. Always want to sign a non-compete. I recorded a specific video around this topic. Go check that out if you're interested. Non-compete enables us to avoid that guy setting up a shop in front of us literally 2 months later and stealing all our customers. So mandatory, part of the deal, non-compete for geographic, a certain geographic area for certain amount of time for certain sectors. Huge risk mitigator. It guarantees that guy is not going to go screw us after he helped us transition the business. Seen that happening many times. I mean, I have examples in Miami back in the day in America. I mean, literally people selling the business and at the same time setting up a new entity to then steal all their patients or the customers, what have you. So that thing happened to people I know. So important for us to put a non-compete in place to mitigate the risk. Number 8, I try to reduce out-of-pocket capital. Many things that we can discuss here. Not going to dive into those because some of them are confidential, but there are ways, of course, to reduce the capital exposure that you have in any deal, which of course reduce your risk as a consequence. So mitigating risk starts from the very beginning. And all these things together really enable us as Ulysses to mitigate risk every time we negotiate and structure a deal. Of course, they're all part of negotiation and the other side has to agree. But if we don't have a good portion of these accepted by the other side, chances are we're not even going to pursue the deal. So we're very picky, but it is the way to go about business deals from my perspective. It's either our way or the highway. And so let me summarize them for you. 1, I analyze the industry and competition. 2, I consider the business growth potential. 3, conduct comprehensive due diligence. 4, keep the seller on board for the transition. 5, I have the seller defer part of the payment. 6, consult with the best. 7, non-competes. 8, reduce the out-of-pocket commitment. These are the 8 things I generally do with my team at Ulysses every time we interact, discuss, negotiate a business deal so that we can mitigate risk. I hope you find this video helpful. I'll see you in the next